Welcome back everyone, I'm Cristina Barthenidu, market analyst, and at this video I'm going to break down three major markets: Aussie dollar, pound dollar, and the US 100, or otherwise the Nasdaq 100 index. This week's calendar includes the Reserve Bank of Australia's policy decision on Tuesday, followed by UK CPI inflation and flash business PMI figures on Wednesday and Thursday respectively. And of course, Fed speakers will attract special attention this week after Moody's unexpectedly downgraded the US's credit rating, causing some discomfort in global markets. So starting first with Aussie dollar and the Reserve Bank of Australia's rate decision, well, expectations are for a single 25 basis point rate cut. Futures markets suggest that two more rate cuts, equivalent rate cuts, could follow in by the end of this year. So it will be quite interesting to see whether policymakers support more monetary easing in the coming months. Just to remind you that the Reserve Bank of Australia has delivered only few rate cuts so far, so but interest rates in Australia are lower than the Fed's ones, so that makes us wonder whether there will be how fast the Reserve Bank of Australia will cut interest rates in the coming months. Note that Australia is not a target of Trump's tariff policy, and its location is of strategic importance to the US. It's, let's say, the entry point to Asia, so definitely Australia may have better trade terms compared to other US's trade partners. So looking at Aussie dollar now, we can see that Aussie dollar failed to climb above the 200-day moving average. It barely rose above this line before it closed below this line last week. It's currently trying to retest this line around the 0.64 50 territory, but we need a decisive close above it, and more importantly, I would like to see a sustainable move above the 0.65 50 territory and above this resistance line to target higher levels, and particularly the 0.66 85 zone, where the price found strong resistance back in November 2024. And slightly above that, the 78.2% Fibonacci retracement level of this downfall is also nearby at 0.67 20, so that territory could be the next barrier once we successfully overcome the 0.65 and 0.65 50 zone. Basically, once we successfully violate this sideways move. Now, looking at the technical indicators, we don't have clear bullish signs yet. The RSI is trying to rebound near its 50 neutral mark. On the other hand, the MACD and the stochastic oscillators are still moving sideways, so we don't have clear bullish signals, and that keeps downside risks in place. So if the central bank delivers a dovish rate cut on Tuesday, probably signaling more easing in the coming months, and or even downgrading its economic forecast, then that could bring fresh pressure in this market. And in this case, I will be looking for a close below the 0.6360 to target the 0.63 and 0.6280 constraining zone, a break of which could take us down to the 23.6% Fibonacci mark of 0.6155. And now turning to pound dollar and the UK CPI inflation and flash business PMI figures. While investors expect inflation to head higher, flash business PMI figures for the month of May could also show some improvement. That could be positive for the British pound, which is currently testing the 1.34 level. It has a nice session so far, and as we can see, technically the price has breached the bearish channel, so a decisive close above this bearish formation could confirm additional gains, particularly if it close above the 1.34 and 1.3440 region, where the price posted a 3-year high back in April. In this case, the next barrier could come near the 1.36 territory, so that could be a significant rally if indeed the price successfully breaches this bearish formation. If we look at the indicators down here, we can see that the RSI and the stochastic oscillator are still sloping upwards, which endorses the positive momentum in the price. So if indeed we close above 1.3440, I expect a test near this constraining line near 1.36. This resistance line over here, which connects the highs from the start of this year, could also come into view slightly around the 1.3747 number. This also coincides with the 2021 high. Now, if bullish pressures fade out and the price closes back below the 1.3260 territory, also violating this short-term tentative support trend line, then we could see a downfall towards the 23.6% Fibonacci retracement of this up leg near 1.3130. The 50-day moving average is adding extra importance to this territory, while the lower boundary of these bearish formations seen near 1.3070 will be closely watched, because as we can see, this support trend line also is located in the same territory. So failure to hold here could activate first selling towards the 38.2% Fibonacci mark of 1.2933. While slightly lower than that, the 200-day moving average might be another spot to watch at 1.2870. And finally, looking at the US 100 index, well, Moody's has downgraded the US economy's credit rating. That caused some discomfort. As we can see, the index is trading lower in pre-trading hours, what we are expecting to see is whether Fed policymakers could resume their dovish tone, if they're really concerned about the Moody's downgrade, which fiscal challenges forced this downgrade. So we'll see whether policymakers could start talking about rate cuts again. If they resume their dovish tone, then that could bring some relief to Wall Street. It could support US indices, and perhaps the US 100 index could hold above this support trend line seen near the 21,000 level. As we can see, the price is not far below its all-time highs registered back in February. We're just 5% below this high. So what we need here is a clear close above the 21,320 barrier, which blocked upside pressures last week, in order to return to the all-time high of 22,236. Perhaps the 22,000 psychological mark could be also a challenge, and if this is surpassed, then we could see this record rally coming back into play, and likely the 22,500 psychological mark could be the next target in this case. Now, if we look at the technical indicators, we can see that the RSI, the stochastic oscillator, are already slowing down near overbought levels. So that suggests that negative pressures could develop in the coming sessions. Perhaps a break below the 21,000 mark could trigger the next bearish action into the towards the 20,315 and 20,500 level. There's a couple of trend lines within this region, as well as the 200 and 100 exponential moving averages are placed here, adding some extra importance. If that area fails to hold, then the 20,000 psychological mark could be the next target, ahead of the 38.2% Fibonacci retracement level of this up leg seen near 19,490. And once we break below the 50% Fibonacci mark of 850 and 19,100, then that could send stronger bear signals to this market, probably eliminating any hopes for a bullish continuation. So that's everything I want to share with you guys. Thank you for watching and see you next time. Bye bye for now.